Welcome to your essential guide on money market funds, the financial tool that could transform the way you think about your savings. In a world where every pound counts, knowing where to park your hard-earned cash is more important than ever. So what exactly are money market funds, and why are so many savvy Brits turning to them as their go-to safe haven? Before you let your cash languish in a low-interest account, let's take a closer look at your options. Traditional savings accounts in the UK often offer interest rates that barely keep up with inflation, meaning your money could actually lose value over time. That's not exactly the security most of us are looking for. With the financial markets swinging up and down, and economic news changing by the day, it's easy to feel overwhelmed. You want a place for your money that's not only safe, but also gives you the flexibility to access your funds when you need them, without locking them away for years or risking big losses. That's where money market funds come in. These funds are designed to be a simple, low-risk way to help your cash work harder for you. They invest in high-quality, short-term financial instruments. Think government bonds, certificates of deposit, and other secure assets, so you get better returns than a standard savings account, but without the roller coaster ride of the stock market. Imagine a savings account that's been upgraded, one that offers you not just safety but also the potential for higher earnings and the freedom to access your money when you need it. That's the power of a money market fund. It's like giving your emergency fund or short-term savings a life jacket, helping it stay afloat and even grow, no matter what the financial weather brings. Money market funds are ideal for those short-term goals, like saving for a holiday, building an emergency fund, or simply keeping your options open while you decide your next financial move. They're flexible, accessible, and designed to give you peace of mind. In this guide, we'll break down everything you need to know about money market funds. We'll explain what they are, how they work, the benefits they offer, and the risks you should be aware of. Whether you're new to investing or just looking for a smarter way to manage your cash, we've got you covered. By the end of this video, you'll have a clear understanding of whether a money market fund is the right choice for your money. Ready to make your cash work harder and smarter? Let's dive in and discover your money's new safe haven. Let's break it down. A money market fund is a big pot where people and companies pool cash. A fund manager lends this money out short-term to governments, banks, and top corporations, reliable borrowers. You earn a share of the interest minus a small fee. The goal: keep your money safe and earn a modest return, often beating inflation. It's not a savings account. Your money is invested, so values can fluctuate, but risk is extremely low. Money market funds are a temporary, low-risk home for your cash. Why do people love money market funds? 3 reasons: safety, liquidity, and flexibility. Safety: they focus on preserving your capital by investing in ultra-safe assets. Liquidity: you can access your money quickly, usually within a day or two. No lock-ins. Withdraw anytime, no penalties. Perfect for emergencies or short-term savings goals. You get a bit more return than a savings account, without the risk of stocks. It's a powerful tool for managing cash smartly. Think of it as a cash plus option. So, what do money market funds actually invest in? Mainly short-term debt, government bills, commercial paper from big companies, and certificates of deposit with major banks. These are all high-quality, short-term IOUs, safe and easily traded. Fund managers only pick the most reliable borrowers. They also use repurchase agreements, safe, collateral-backed deals with banks. The result: your money is spread across many secure, short-term loans. This keeps the fund safe and liquid. No stocks, no long-term bonds. Just ultra-low-risk, short-term lending. That's how your cash stays protected and accessible. It's all about safety and stability. When it comes to choosing where to put your money, the options can seem overwhelming. So, where exactly do money market funds fit into the bigger picture of personal finance and investing in the UK? Let's break it down in simple terms, so you can see how they compare to other popular choices, like savings accounts, bonds, and stocks. Money market funds, or MMFs, are often seen as a middle ground. They're generally safer than stocks and bonds, but they tend to offer better returns than most traditional savings accounts. This makes them an attractive option for people who want to earn a bit more on their cash without taking on too much risk. Savings accounts, for example, are protected by the Financial Services Compensation Scheme, or FSCS, up to $85,000 per person per bank. This means your money is very safe, but the trade-off is that interest rates are usually quite low, especially when inflation is high. So, while your cash is protected, it might not grow much over time. On the other hand, money market funds aren't covered by the FSCS, so there's a very small risk involved. However, these funds are designed to be extremely low risk, investing in high-quality, short-term debt instruments. Historically, losses are rare, and the risk is considered minimal compared to other investments. Now, let's talk about stocks. Stocks can offer the highest potential returns, but they also come with the highest risk. Prices can swing wildly, and there's always the chance of losing money, especially in the short term. Money market funds are almost the opposite. They offer modest, steady returns with very little risk of losing your initial investment. Bonds fall somewhere in between. They usually provide more income than savings accounts and MMFs, but they also carry more risk, especially if interest rates rise or the issuer faces financial trouble. So, bonds can be a good option for those willing to accept a bit more risk for potentially higher returns. The key thing to remember is that money market funds are best suited for short-term stability. They're not designed for long-term growth like stocks or even some bonds. Instead, they're ideal for people who want to keep their money safe and accessible, perhaps while saving for a big purchase or waiting for the right investment opportunity. Think of money market funds as a step above holding cash in your bank account. They offer a bit more earning potential, but without exposing you to the ups and downs of the stock market. They're a safe place to park your money when you need it soon, but want to earn a little extra in the meantime. Use money market funds for short-term goals like building an emergency fund, saving for a holiday, or setting aside money for a home deposit. They're also a great option if you're waiting to invest in the stock market but want your cash to work for you in the meantime. In summary, money market funds are a specific tool for a specific job. They fill the gap between the safety of savings accounts and the higher risk and reward of stocks and bonds. By understanding where they fit, you can make smarter choices for your financial future. How do money market funds set their returns? They track the Bank of England's interest rates, especially the SONIA rate, the average overnight lending rate between banks. When the bank rate rises, MMF returns rise too, almost instantly. If rates fall, so do returns. Your return is the average of all those short-term loans minus a small management fee. It's transparent and adjusts quickly to market changes. No fixed rates. Returns move with the market. You get a real-time reflection of the value of cash in the financial system. You'll see two types: income, INC, and accumulation, ACC. Income pays out interest as cash. Great if you want regular payouts. Accumulation reinvests interest, growing your investment over time. For most savers, AC is the way to go. Let your money compound. Example: invest $10,000. With income, you get interest paid out. With AC, your investment grows automatically. Pick income if you need cash flow, AC if you want growth. Both are low maintenance and easy to use. Choose what fits your needs. For most, accumulation is simpler and more efficient. Where should you put your money in 2025? With interest rates fluctuating and economic uncertainty still lingering, finding a safe place to park your cash is more important than ever. Many UK savers and investors are now turning to money market funds as a way to earn a bit more on their savings, while still keeping risk low and access easy. But with so many options out there, how do you choose the right fund for your needs? Here are some of the top UK money market funds to consider for 2025. These funds are designed to offer stability, liquidity, and a competitive yield, making them a popular choice for both cautious investors and those looking to temporarily park cash before making bigger investment decisions. When evaluating money market funds, always look for low fees. The ongoing charges figure, or OCF, is a key metric. Aim for funds with an OCF under 0.2% if possible. Lower fees mean you keep more of your returns, which is especially important when yields are modest. The Royal London Short-Term Money Market Fund is a standout option. It's one of the largest and most established funds in the UK, with a long track record of safety and reliability. Its low-fee structure and focus on high-quality short-term assets make it a solid choice for conservative investors. Another excellent choice is the L&G Cash Trust Fund from Legal & General. This fund is known for its safety, low costs, and strong reputation. If you prefer the flexibility of exchange-traded funds, or ETFs, there are also great options available. The Lixor Smart Overnight Return ETF, ticker CSH2, is a popular pick among ETF investors. It offers daily liquidity, tracks overnight interest rates, and charges very low fees, making it a smart way to keep your cash working for you. Alternatively, consider the X-Trackers Sterling Cash Swap ETF, ticker XSTR. Like CSH2, it tracks the SONIA rate, the benchmark for overnight interest in the UK, and is known for its transparency and low costs. Both ETFs are designed to closely follow the returns of the UK's overnight money market. When comparing funds, pay attention to both fees and fund size. Larger funds often offer greater stability and liquidity, which can be especially important during times of market stress. Reviewing past performance, while not a guarantee of future results, can also help you understand how a fund has managed different market conditions. Decide whether you prefer traditional funds, which are priced once daily, or ETFs, which can be traded throughout the day like shares. ETFs offer more flexibility, but traditional funds may suit those who want a simple, set and forget approach. For most investors, the most important factors are low fees and easy access through your chosen investment platform. Make sure the fund you select is available on your platform and that you understand any additional charges that may apply. Always do your own research before investing. Read fund fact sheets, check independent reviews, and consider your own financial goals and risk tolerance. Money market funds are generally low risk, but it's still important to know exactly what you're investing in. These funds are solid starting points for UK investors looking for safety, liquidity, and a bit of extra yield in 2025. Take your time, compare your options, and make the choice that best fits your needs. Ready to act? Here's your plan. Decide if a money market fund fits your goal. Short-term, low-risk savings. Open an investment account on a platform like Hargreaves Lansdown, AJ Bell, or Vanguard. Check platform fees and make sure they offer your chosen fund. Pick a fund with a low OCF, under 0.2%, high credit quality, and the right type, ACC or Inc. Place your trade. It's as easy as searching the fund name and clicking Buy. Monitor your investment, but don't obsess. Withdraw when needed. Money usually arrives in a couple of days. Simple, flexible, and smart cash management.